Hey, it's Mike, and for today's trade strategy video for today, this was actually suggested in the comment section, and I totally forgot who suggested, so I apologize for that. But I thought it was a great idea, so I wanted to do this video and share this information for you. It's 5 macroeconomic factors every investor should know. So, the good thing is for the past decade, we haven't had to actually worry too much about macroeconomic factors because everything seemed to be okay. We had low unemployment, we had good low inflation rates. But I think now we're going to have macroeconomic factors are going to play a bigger role overall in the stock market. So it's going to be important to know what these factors are and how to navigate your investments around them so you don't end up in a bad investment or end up seeing huge sudden drawdowns in your portfolio. So I'm going to go ahead and take a look at 5 macroeconomic factors every investor should know. So the first one you should know, probably the most important, are interest rates. So interest rates are simply the cost to borrow money. The higher the interest rate, the harder it is for some businesses, borrowers, and investors to have access to money. A high interest rate environment can make it challenging for new businesses. We have been at historically low interest rates for several years. So that's why the stock market has really been moving up. So, because if you're a new business, if you have a new idea, there's a lot of money out there, a lot of easy money. So there are a lot of investors who are willing to throw you a couple $1,000,000, a couple tens of millions of dollars to start your business. But if interest rates go higher, it's going to be hard to get access to that money. So it's going to be harder for new businesses to survive. It's also going to be hard for struggling businesses to survive because it's going to cost them a lot of money to get access to capital. So it just makes things a little challenging. So when you see higher interest rates environments, you're probably going to start looking at high quality companies that make a lot of money that are not going to have issues with cash flow. Companies like your Apples, just cash generating machines. You may get a point where looking at things that will pay you a high rate of return, like high interest rate savings accounts. Certain treasuries might become attractive if they pay a high enough interest rates. But like I said, we're in low interest rate environment right now, so it's not too much of a worry. But if you see interest rates going up, then you have to be a little more selective where you deploy your money. The second macroeconomic factor we'll look at is inflation. Now, in the United States, inflation is measured using the Consumer Price Index. This tells you the rate of increase of the price of goods and services. Currently, the inflation rate is 2.24%. The higher the inflation, the more expensive goods and services are. This makes commodity assets more valuable and makes it harder for some businesses to realize a profit. So in a high inflation rate environment, you want to look at gold, silver. You want to look at commodities that are going to be very precious for industrial uses. I talked about lithium in a video before. So you want to look at those. Then you want to avoid companies that are going to get hurt by inflation. Companies that work with really tight margins are going to get hurt. Just the stock market in general, the general stock market will get hurt while commodity stocks, gold stocks, silver stocks will do well. Bitcoin will actually probably do well because it is a digital asset that is scarce, that has natural scarcity built in. So definitely watch the rate of inflation. It's low right now, but it sounds like inflation may be going up for a couple of reasons, but definitely check that and check out the Consumer Price Index. The third thing we'll look at is unemployment. So unemployment is the percentage of people who are not fully employed. The unemployment number is calculated by the federal government and reported on the third Friday of the month before market opens. This number has a big effect on the stock market. The higher the unemployment, the worse the stock market. So the unemployment number has been pretty low. Even, the funny thing is, even with the pandemic, the unemployment number shot up really high, but then came back down really quickly because a lot of the people who are unemployed, it was sort of a temporary situation. Now, some people would argue that the real unemployment rate is higher. It's in the double digits because the unemployment numbers that the federal government uses may not factor in, people who are just working part-time. But historically, as reported by the federal government, the unemployment number has been stabilized and kind of low and doing okay. But if you see the unemployment number reported by the government headed into the double digits, that's going to scare people from investing in the stock market. So you just want to keep that in mind. The higher the unemployment number, the bigger the negative it is for the stock market. Economic growth. So the fourth factor, economic growth, is defined as the value of goods and services produced by the economy over time. It is measured as a percentage rate of increase to the gross domestic product, the GDP. To determine economic growth, the GDP is compared to the population. This is known as per capita income. So this is just talking about the overall rate of wealth growth for the country Um, the U.S. has the highest GDP in the world and one of the highest per capita incomes in the world. So when you look at economic growth, you're just looking at how healthy the overall economy is. Now, it doesn't say that the average person is doing well, but it just says the country as a whole is doing well. And so when economic growth is moving higher, then the stock market is going to do well. One of the definition of um, a recession is 2 consecutive quarters of negative economic growth. So if you see economic growth go down for 1 quarter, that means that there is a chance that we may get a recession because we may have a second quarter of negative economic growth. So that's something to watch as far as like when you look at what recessions are. Um, it's 2 consecutive quarters of negative economic growth. And finally, the last thing we should look at is GDP to debt ratio. So a GDP to debt ratio is the government's debt and the GDP. A low GDP to debt ratio indicates that the economy produces goods and services that are sufficient to pay back debt without incurring further debt. The current U.S. debt to income ratio is 136%. This is the highest it's ever been. In fact, after World War II, the debt to GDP ratio was 90%, which was considered super, super high, but that came down pretty quickly. We are at a crisis level with GDP to debt ratio at 136%. The thing that really helps prevent our economy from collapsing is that we have the reserve currency, so we can just continue printing dollar bills, hundreds of billions of dollars and trillions of dollars, and people are still buying our bonds. Now, that could change at a moment. That's why you have to make sure that your portfolio is hedged either with gold and silver stocks, or with Bitcoin, or just something that's scarce, because US dollars are not scarce, and we're just kind of printing our way out of trouble, but that could end at any time. So you definitely want to check the GDP to debt ratio. If it continues moving higher, that means there could be a risk that people will just suddenly devalue the dollar, and we could be in big trouble there. So just to summarize here, the 5 macroeconomic factors: interest rates, inflation, unemployment, economic growth, and GDP to debt ratio. So to conclude, knowing macroeconomic factors will help you better understand the stock market, how the stock market works, and will help you make better investment decisions in all market environments. And that's the important part, all market environments, because just because you have high inflation doesn't mean you have to lose money in the stock market. In the 1970s, the people who did really well in the stock market were investing in oil, gold and silver miners, etc. So if we do have a high inflation environment, you'll know where to deploy your money. Okay, so I hope you enjoyed this video. If you did, please be sure to leave a like and go ahead and subscribe and turn on notifications. I do multiple daily updates on stocks, stock trading strategies, and market updates. Thanks a lot. Bye.